Okay,
We can hear you, and we are live. Rob, good to see you.
you too.
Where are you on the home front today?
I'm in Reno, Nevada.
Reno, Nevada, which is your home front. So, or mostly.
Yes.
Yeah. So,
You know what we should have done today, Rich, in honor of Pete being here, is
mhm.
gotten a little like Vincent Van Gogh, whatever this is.
The goatee. I try. I can't grow one like Pete. I've got like the perpetual like 40%, going. I just can't grow facial hair. It's odd. But Pete's is impressive. I would agree. Pete, how's it going? Good to see you.
Well, well, good to
His
see you
beard,
guys.
we're talking. If you're listening to
How are
just
you
the podcast, we're talking about Pete's beard, so being impressive. So
I don't have a Facebook page, but my beard does.
that was not in the prepared script either, Pete. Good work. We're off to a quick start here. So
I think Rich has one or two of his dogs who have Facebook pages.
or rap sheets, yeah, or both. So
Right.
yeah. My crazy French bulldog to this day is still the chatbot on the Mortgage Collaborative website. So if you go to the Mortgage Collaborative, you go to mortgagecollaborative.com and ask the chatbot a question. It's my crazy killer French bulldog Frankie. So it's living on. So all right. Well, let's go ahead and get into it. I'm Rich Swerbinski with Onward and Upward Consulting, and this is the big picture presented and sponsored by our great friends at Depth, founded by mortgage industry vet Carrie Milam, managed by her outstanding EVPs, Lindsay Neal and Leslie Colley. Depth is the PR and marketing firm for getting fintechs noticed and fast. So if you're a startup or looking to scale up, and you need to be have your story told. Depth will help you stay ahead of the pack and do a great job in doing so. Focused on that fintech space, so their ideas go deep and their PR wins go deeper. Check them out at depthpr.com, or just get a hold of Rob or I, and we'll get you connected with them. Rob, your hand per usual is up early.
Yeah, up early, Depth, good firm. Pete, congratulations on getting Mike Olden to actually write in all the way from the Pacific Northwest. I don't know if Michael's ever written in for our previous guests. So, hey, Michael. The second thing is, Pete, did the NBA actually pay somebody to come up with like some kind of primordial fern palm thing against a brick? What is that in the background there?
Yes, Mark.
I'm sure you're at home.
I'm actually, interestingly enough, I'm in a law firm office down the street because our entire block lost power this morning. So scrambled to get here, and this is our faux background. It's not my office.
All right.
Well, we appreciate it, Pete. The extended efforts to make it happen today, and hope good luck on getting the power back. So,
Yeah, fingers
Rich,
crossed.
did you notice how Pete snuck in a little foreign language lesson there? Faux.
it was over my head. Yeah, is that is I did hear it though.
It's almost a good wordle word, but it's only got four FAU. Yeah, never
Is
mind.
Wordle still a thing? I'm sure it is. I haven't partook in a while.
Yeah,
Yeah.
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 I still do it,
The New York Times bought it, if I remember correctly, is the story. That went crazy for like 3 months. It was the hit of the internet, and then the New York Times bought it, and it's still going. So,
Yeah.
all right. All right, let's go ahead and get into it. And once, as always, join my esteemed colleague and co-host, Rob Chrisman. Rob, great to see you.
You too.
And this week, very, very pleased to be joined by a very special guest, MBA Senior Vice President over most of the important things that they do. It is our good friend, Pete Mills. Pete, great to see you, and thanks for battling the power issues to join us today.
Thanks, and happy to be on. Looking forward to it.
Love it. Good stuff. And Rob, the news as always, robust this week. Of course, President Trump, floating out, leaking the fire Powell rumors to see how the markets react. We got a fresh batch of inflation data. CPI and PPI came out this week, mixed, largely muted tariff impacts if you look at the big picture on it all. And then, of course, the Vantage and FICO score talks that continue to kind of ripple through the industry. And by this point, Rob, I throw that all at you, and you get us going.
Well, I found it interesting. Of course, Pete, we're going to talk about things in front of you that obviously you're probably not going to be able to talk about or don't want to talk about. But I found it interesting that was it Friday evening, Friday afternoon? FHFA Director Bill Pulte comes out with a tweet. Oh, I'm sorry. No, no, no. The FHFA came out with an official announcement through official channels saying that here's a quote from Director Bill Pulte saying basically that Jerome Powell is considering resigning. Okay, so this is through the FHFA. All right. And I actually wrote back to the FHFA asking where these reports were coming from, did not receive word back. And then Bill Pulte comes out with a frequently asked questions regarding credit policy of the agencies. And instead of using the official FHFA channel or Fannie or Freddie channel, he tweets it out. He basically, I think, tweeted a photograph of something that he had printed out or some document on his computer. So I thought I still can't grasp how Bill communicates or wants to communicate or best communicates with the industry. So Pete, maybe you can think about answering that. But I thought it was good that he came out with a frequently asked questions because when he said effective immediately with regard to Vantage and rental income and so forth, it almost raised more questions than it answered. And the NBA has been on the forefront of saying, well, what about this? And what about that? And it doesn't do this and it doesn't do that. And these things take time. And we look forward to the traditional NBA statement. We look forward to working with, fill in the blank, which is always a good thing to say. But I'd like to
And
toss
do.
this. Right. Like to toss this back to Pete and say, and ask, what is your take on Bill Pulte's method of communication, first off? And did he in his frequently asked questions answer many of the questions that the NBA has been so right in raising?
So, look, I think on the issue of a method of communication, he's not the only one in this administration that is using alternative forms of communication. So, look, we've gotten used to it. We monitor the Twitter feed. Stuff comes out, and we have to react. They did post the FAQs, by the way, on their website, so they're there now for folks to look at. So. Look, I think directionally we support more competition, but as you noted, there are a lot of details that are missing. And the FAQs answered some questions, but certainly not all. And I think the good news is that there is already a process in place with the GSEs and FHFA and industry groups to begin to sort through those answers so that at some point we'll be able to actually deliver. I mean, you might be able to get a Vantage score today, but you can't deliver along with Vantage score. You don't have pricing. You don't have LLPA grids. You don't have, for Fannie in particular, where you've got a 620 FICO hurdle rate to get eligibility. We don't know what that is for Vantage. So there's all those questions are sort of in the queue, and we'll begin working with each of the GSEs to get those answered. Some of the things that were answered, we now know that it is either Vantage or FICO, but not both on a single loan. There's also the ability to deliver a Vantage on Rob's loan and a FICO on Rich's loan, for example. So you can do that. But there are also a lot of things to be worked on around what I would call gaming issues. How do you make sure that lenders aren't gaming one score versus the other. Those are open questions that need to be addressed. Some of the, I would say maybe longer term issues, the FICO score is embedded in the GSE capital rule. It's also embedded in the PMIERs, which is the capital standards for the MI industry. But right now, there's a whole series of meetings going on. The GSEs and FHFA, they're meeting with the MI industry. They're meeting with lenders. They're meeting with investors. We've strongly recommended they start meeting with vendors because we got to get the LOS and the POS and all the vendors ready, prepared to, how do you deliver and distinguish? It's a two-score world now. So you have to create new fields to report a Vantage versus a FICO, or how to tag the credit score you're reporting as one versus the other. All these questions need to be answered. I think we are probably in the nature of months away from this, not weeks, but we are sort of in the realm of weekly, if not more frequent meetings to begin to identify the questions and then begin to work on the answers.
That's outstanding insight, Pete. Thanks for rolling through that, and not surprising you guys are all over it. What about the correspondent lenders? As we've seen with e-close, like Fannie and Freddie can be good with anything, and if the correspondent, the aggregators don't, jump into bed, then it really, it mutes the impact to the greater market. Is there a way to force the correspondent lenders to come correct on this?
I don't think so. They'll make their own decisions about what scores they're going to be willing to accept. I would think most of the large correspondents would probably find a way to offer both. But I think we're a ways away from making those decisions until we understand pricing grids. I mean, the big open question in all of this is, how are the investors going to react? Are they going to pay up or pay back on pools with high percentages of Vantage versus FICO? We don't know.
Mhm.
So a lot of open questions on that front as well.
So
That's
do you
probably the
see,
big one.
do you see an originator or broker running both? You mentioned gaming the system, but doesn't that drive up the cost to a lender if they have
As-
originators running both?
Yeah, presumably, don't know. Again, we don't even know how the bureaus are going to price Vantage versus FICO. So there may be distinctions there as well that drive adoption or discourage adoption. I do think this, so one of the things in the FAQs talks about developing, they still need to work on ways to mitigate certain risks. I think it's gaming risk that they're talking about. And the question will be, can you order both and pick one, pick the better of the two? I think that will be one of the issues that they're going to try to build business rules around so that you presumably can't game the system. I would imagine that the GSEs themselves would be strongly in favor of trying. These are a lot of the same issues that we were dealing with in the conversations around buy merge and two scores. We now have to, given the effective immediately aspect of it, we now have to find a way to move faster on those questions. And that's one of the things that I think Pulte is trying to do. He's looking at this. You guys have been working on this for 3 years. I'm going to put this out there, effective immediately. You guys figure it out. So it sort of lights a fuse.
And I gotta say, I do like that. Just kind of throwing the turd in the punch bowl here. I mean, because historically, the mortgage industry, I mean, just
Can you
years.
say that on a podcast?
Is that a mortgage term?
There's an acronym for it, I'm sure. Turd in punch bowl. Yeah. Yeah. Yeah, I mean, I do like that part of it. That said, it's creating right now kind of a flurry of things for people to react to. I saw something, somebody speculating on LinkedIn this morning that they were speculating that Vantage Score could come out with like super aggressive pricing, like out of the gate to gain, like a lot of new companies would do, to gain adoption and get on the radar and get clients signed up. But if they came out to like a super low price, that it would complicate things, and that lenders would be flocking to it and be pining for all these answers that you guys are working so hard to provide, right?
Yeah, no, look, I do think, so there's the pricing issue. Certainly, we don't know what that's going to look like. And look, from FICO's perspective, Vantage is owned by the bureaus. So, you can imagine why they're concerned about that risk. And right now we have a situation where it's FICO or classic, I'm sorry, it's classic FICO or Vantage 4.
Mhm.
It's not FICO 10T and Vantage 4. Now they have done at FHFA the validation of the FICO 10T model, but they're holding back for reasons that I'm not privy to. They're holding back 10T and putting Vantage out there. So it's Vantage versus a 25-year-old score. That's not necessarily fair competition at the moment. So that remains an open question as to how long. They do say that at some point 10T will be available. We don't know what runway that's on it and how far behind it is.
Interesting. And thank you, Shelby, for the acronym TIPB. It's another new mortgage acronym for us all for turd in the punch bowl. So thank you, Shelby, for that. Pete, the trigger leads, Bill, fresh momentum, MBA's efforts there. How optimistic are you about movement this session?
So the challenge right now, so this whole effort's been like a 15 play drive down the field. And quite often the last 5 yards are the hardest.
Mhm.
That's where we are. And we're working on our version of the tush push to try to figure out how to drive it across the goal line. And so look, I mean, you've got a House bill, you got a Senate bill, they're very slightly different. I do think at some point, given that the Senate bill, I'm sorry, the House bill took an amendment to do a GAO study, that will probably be the final vehicle. So the effort now is how do we find a path in the Senate? This bill has been through the Senate twice on unanimous consent. That is not easy to do. And so I think in looking at this issue, it's, how do we find time on the Senate floor for another UC on this particular bill? And that's the challenge we're looking at. We want to push it through as a standalone. We don't want to have it ride another bill because that could put us out later in the year. So we're doing everything we can to try to find a path to get that bill taken up as quickly as possible. You could theoretically go House takes up the Senate bill. That's another option. So our ledge team is actively engaged in those discussions and trying to find the quickest path forward. But like I said, the last 5 yards are the hardest.
Mortgage Action Alliance is like, is a push there, like from the industry.
That will come to bear at some point once we identify what that path is, and understand, is it a House play? Is it a Senate play? Once we have that locked in, absolutely anybody who cares about this bill, and we've done a number of calls to action over the course of this year, be prepared, and that's the time for people to respond ASAP and really push this thing over the goal line. But Ma will play a role in that for sure.
And for any not aware of the Mortgage Action Alliance, it is completely free to sign up. You don't even have to be an MBA member company, I don't believe, right, Pete? No.
You do not.
It's an individual thing, and they do an incredible job with it. It's basically, I mean, marshaling and educating us in the industry on critical issues, and preset templates and
Yep. It
reply
literally takes maybe 2 minutes to log in from the app off your phone and send a letter.
and send a letter to
Good.
your legislator, with
Yep.
MBA talking points in there, and it's been really effective, and just the work that MBA is doing, and the knowledge of the issues for our legislators. So, Mortgage Action Alliance, Google it, and it's free to sign up, and it's a very, very valuable and meaningful service to the industry for anybody that's not doing that currently. So,
So tomorrow, Pete, I'm running I guess August. There's some push in August, but Pete, here's what you need to suggest to the MBA marketing squad or Covey or pod or team or whatever you call the marketing group there who designed that Palm Firm thing. You need to say, look, we've got an event in Las Vegas. Let's make, 5,000 pens. Pens are cheap. Put put the Mortgage Action Alliance information on them and distribute them to the surrounding restaurants from the conference hotel or in the conference hotel, so that when people are signing their bill or people are taking their clients out to lunch or whatever, there it is. It's in their hand. Mortgage Action Alliance. Pens aren't expensive. Help get the name out there. Run that by the squad.
Got it.
That's actually a good idea, Rob. I was, thinking you were crazy 10 seconds into that, but I like that.
Well, Pete, this idea will die on the vine because Pete isn't going to talk to his marketing team. But
Why do you say that, Rob? Of course I will.
Well, let's go NBA. And since Rob brought it up, NBA annual Vegas this year.
Oh God,
Rob, you
who's,
don't like
who's
in
Vegas.
charge of this stuff?
You're not a Vegas fan, are you, Rob? Right? We've talked about this before.
And the question I have is like I'm sure Marcia will have her Empower event on Saturday. So that means people are coming into town Friday, right? So they've got Friday night, Saturday night, Sunday night, Monday night, Tuesday night. That's 5 nights in some Las Vegas hotel. That's a lot
Fine
of
hotel.
yeah. That's a lot of Las
People
Vegas
love
hotel
Vegas,
time.
though. People do, people love Vegas. I think it's going to be a good turnout.
Sure.
Have you guys announced
not-
the band yet, Pete, for the Tuesday night?
We have. It's frankly, this is very cool. So normally we have a concert MBA that you're all aware of. The band this year is One Republic. We had them first conference coming out of COVID. They're coming back, and they were phenomenal at was it, I guess 2021. But the really cool thing this year is we have an opening act before the band, a comedian, one of my favorites, actually, I think he's hilarious, Jim Gaffigan.
Oh, really?
Yeah.
Man, that's a big
Yeah.
name. So
Yeah.
Gaffigan
So
opening for One Republic.
yeah.
That's solid work. So
Yeah.
all right, good. I like it. So
Yeah.
and that's coming up.
Rob didn't think of that one.
Yeah, Rob, where are we on that?
Well, I like Jim Gaffigan too. And he's relatively clean, unlike Rich, talking about punch bowl activity. That would never come out of Jim Gaffigan's mouth. But yeah, that's a good lineup.
Yeah, it's a great lineup. Great speakers. I think the keynote, this will be fascinating. And Rob, I know you will be in the room for this one. Conversation on the economy with Kevin Warsh, and who is rumored to be perhaps the next chairman of the Fed, and former Treasury Secretary Larry Summers. So you get a little bit of a left-right perspective on economic policy and where we're headed.
Love it.
That'll be a great session.
Love it. Love it.
Yeah.
Pete, the home builders, I think that was one of the only in the last election bipartisan agreement issues. I think both sides kind of agreeing. Yeah, we need some help for the home builders to be able to build homes under $500,000 in America, single family. And obviously, the tax bill and tariffs have kind of taken priority. But I think growing chatter now about help for the home builders. Home builder sentiment is not great right now. We clearly need to build a bunch of new homes in America. What any tangible policy changes that could actually move the needle that you think are realistic in the coming weeks and months?
Coming weeks and months is the bigger challenge. So as you know, the housing supply issue is predominantly a state and local issue.
Mhm.
The real big barriers to boosting supply significantly are state and local issues around zoning, permitting, impact fees, environmental rules, et cetera. And there's not a lot you can do from Washington. I know there's some efforts to sort of provide some carrots and sticks in terms of connecting federal grant monies to localities that have housing forward zoning, permitting, environmental rules, et cetera. And that may start to incentivize some of the right behaviors at the state and local level. That'll be helpful. The federal government is looking at selling federal lands, and I think that's starting to ramp up a little bit. I think some of the headwinds, though, are tariffs on You know, we got lumber, you've got appliances, you've got all these potential headwinds, if you will, that might sort of cut against some of the efforts to boost housing supply. So hopefully trade deals come through, and we don't face those headwinds, but it's a challenge. More specifically, maybe more tactically, we're in conversations with the GSEs around ways, particularly for independent mortgage bankers, to take a bigger role in construction to perm lending, one-time close. How do we find a way to securitize those loans in the draw phase still, as opposed to having to hold those for the full phase before you securitize them? Trying to make sure that the documents that you use to underwrite the borrower at the beginning, they expire after 12 months. We're trying to push that date out a little bit to take some of that risk out of the system. So there's some work being done around that as well, to help boost supply of construction finance. Not the big builders, they've got their side covered, but more for the infill developments, the smaller developers, and the folks who are buying land and building their own homes. That C2P program for IMBs would be really helpful. So a lot of things in that space. Yeah.
Oh, I'm sorry. Well, I was gonna echo Brian Levy's question about LO comp. Is that a what they're I've written about it in my commentary recently about some ideas that are out there. Is that on anybody's radar screen? It's a very complicated issue.
So LO Comp is absolutely on the radar screen. We've sent just this year probably 3 different letters in response to different executive orders on regulatory reform, et cetera, highlighting what we've been advocating for really since 2018. Some of the LO Comp reforms that we've been pushing forward. Most importantly is sort of the ability of the loan officer to reduce comp to address bona fide competition. Bond loans is another really important one. So we've been pushing those issues forward at every opportunity with OMB, with CFPB directly. We got very close in 2019 under Kathy Kraninger. And then, as we all know, elections have consequences. And the air came out of that when Chopra came in. So we are sort of spinning that back up again. The issue right now with CFPB, as you know, they've had a they're significant headcount reduction that is tied up in court at the moment, but there's been a 90% reduction, and most of those folks are on sort of administrative leave until the litigation works itself out. Our hope is that there'll be sufficient staff, probably more than the 200, but certainly not necessary to go all the way back up to the 1,700 they had before. But let's make sure the CFPB is staffed up enough to do the important work around reforming LO Comp, RESPA reform issues, some of the things that are carryovers from the Cordray and Chopra era that need fixing, need reforms, things that went too far. So there is a big focus on that. LO Comp has been at the top of our list in every one of our communications, but I don't think the Bureau is there yet. Right now, they're focused on rescinding Biden era rules that they felt were overreaching. We've been making recommendations and having some success in that space around the non-bank, what they call the repeat offender registry. That is likely to go away. We are looking at, in other agencies, looking at, in fact, it's open for comment now, the energy code rules that FHA had put in place that would have required any new home financing to be only on homes that meet the 2021 International Energy Efficiency Codes. Only 9 states have adopted that. That would have been a significant challenge. That's likely to go away as well. So I think, but right now the focus at the Bureau is around rescinding things. They did a request for information around rescinding all prior guidance. All prior guidance would have been a problem. We sent over a list of about 24 guidances that we wanted them to retain, all of which were retained. They rescinded, probably 50 or 60 others. but did preserve the ones that we rely on in our industry to make sense of the rules and the statute. So we've had some successes there as well. But I don't think until we get a nominated confirmed director over there that those longer term, let's tackle LO comp, let's tackle RESPA reform, let's tackle some of these bigger issues. I think that's going to have to wait until we get a confirmed director over there.
That's right.
The agency, in this case, the CFPB, doesn't it have certain congressionally mandated minimum things, tasks to accomplish, roles that it's assigned to deal with?
Yep.
I made
It
the
does.
comment recently about couldn't somebody cut the CFPB staff so there's just Pete Mills sitting there by the phone being a receptionist and that's it.
No,
And they said,
and
no,
that
no,
was
no, they can't do that.
so early on. It was rumored that the vision for CFPB was 5 guys in a conference room with a phone.
Right.
That's not, and that's so the initial riff was everybody go home. We'll let you know what's going to happen. Again, a lot of this is tied up in litigation. The 200 folks that we're at right now, that again, this is tied up, but they've designated 200 people and they went through a process where they said CFPB is required to do X. We need 25 people to do X. Where today or prior, they would have had 250 people. Whether those 25 and the 250 lines up is sufficient to carry out statutory duties is a longer term question. I do think there will be significant reductions in the long run. Whether they get it all at once with this 90% RIF remains to be seen, but they're required to do a particularized assessment when they do these kinds of layoffs. And what we are stuck with at the moment is that initial particularized assessment. It was done rather hastily, so that's an open question as to whether the 200 is enough to do all the statutorily required duties. But that's
And are
just,
you hearing from your members? This is a continuing issue that I bring up in my commentary is, just because the CFPB is scaled back, that doesn't mean the Californias, the Illinois, the New Yorks are equally going to withdraw into their shells. And in fact, quite the opposite. Are you hearing from
yeah.
members that indeed the states are gearing up?
Hearing from our members, hearing from the states. I mean, we've had conversations through Armor and the CSBS. There's absolutely efforts to fill the perceived or real gap from CFPB sort of pulling back from the field. Obviously, New York, California, Massachusetts, et cetera. I certainly expect those states to step up, whether it's in the examination space. We're hearing that some states aren't approving licenses for companies that want to do predominantly non-agency business. I don't know what the rationale is for that because you get a license to lend, not a license to lend only certain types of loans. So we're seeing this already, absolutely. Attorneys general will certainly be much more active in the enforcement space, I would imagine. Look, Chopra, when he left, the week before he left, gave the states a roadmap on how to enforce CFPB's rules, how to go beyond the CFPB's rules. And certain blue states and even some red states might certainly look at that roadmap and begin to execute to it. So we're on high alert for those sorts of things. Our members are feeding us issues as they come up. Our state associations obviously doing the same thing. But that's not the only risk. I mean, the statute of limitations is such that 4 years from now with a different administration, a different CFPB head, what you did from 2025 to 2029, 2028, because you felt there wasn't going to be any scrutiny from the CFPB, all that can come back to bite you. And then again, a number of the Dodd-Frank provisions have private rights of action. So The idea that, everybody goes on a compliance holiday for 4 years, I think is something people should not consider doing.
This is The Big Picture, presented and sponsored by our friends at Depth. For nearly 2 decades, Depth has been the trusted communication and marketing partner for fintechs, reshaping housing finance from POS to LOS, everything in between. And check them out at depthpr.com or get a hold of Rob or I if you want to learn more about the great folks at Depth. Pete, MBA has long supported responsible GSE privatization. What does a viable path forward look like potentially in the current kind of political and market environment?
Yeah, so political environment is probably the important one at the moment, in that, the prior administration really showed little interest in moving forward on GSE reform. The current administration, as we know, has a different view. The Hill has basically, the Republican leadership in House Financial Services Committee, Senate Banking, has basically said, look, show us a path for getting the GSEs out of conservatorship. We want to be consulted, but we want to see your plan. And so I certainly expect this will be what I would call an administrative reform effort, not going back to where we were in 2015, 16 with Johnson Crapo and sort of reshaping the entire secondary market. We're going to have two GSEs at some point. They're going to exit conservatorship. It was never intended to be a permanent state. So this is going to be administrative reform path. In terms of how they're looking at it, they've sort of, in our conversations, sort of outlined 3 buckets of reforms and issues that they need to tackle. First bucket is what I call the sort of the capital stack. What do you do with the warrants that the Treasury holds? What do you do with liquidation preference and the preferred stockholders, et cetera, before they can be released and re-IPO'd, if you will. Second bucket is what I call sort of the capital bucket, but the capital that the GSEs actually hold, the regulatory capital issues. So when are they going to have enough capital to stand on their own 2 feet in the private sector? And what should the final capital rule look like? If you listen to Bill Ackman and the people that are trying to blast them out fast, they want to go back down to 2.5% capital. I don't see that happening. I think Mark Calabria made it very clear he wanted them to have bank-like capital for the assets that they have, either on balance sheet or that they guarantee. So I don't see that happening. And then the final bucket, third bucket for the administration, is what I call the sort of the mission issues, the footprint issues, the things that we really care about, will be in the third bucket. We sort of define sort of 2 additional buckets that have to be addressed along the way. First is, if you're going to release the GSEs from conservatorship, you're going to have this powerful duopoly out of conservatorship, operating on their own. So what are FHFA's obligations as a regulator, not as conservator? So a lot of things that have happened over the past decade and a half around level playing field, leveling out G fees so that the biggest lenders don't negotiate the lowest G fees. Those are things that they use conservatorship powers to do. How do we make sure when they exit that FHFA, as the regulator, not the conservator now, but as the regulator, maintains those kinds of market conduct rules that have made the market much more competitive, allows smaller lenders and mid-sized lenders to compete fairly in the GSE space. So that's our sort of third bucket. I call those the FHFA reform bucket, if you will. Let's make sure that they have the authorities, and not just the authorities, but the obligation as the regulator to make sure there's a level playing field, make sure that the GSEs stay in the secondary market and don't encroach in the primary market. They don't, market directly to consumers. Some of the things that we've seen in the past, and going back a long ways. But let's make sure we don't repeat some of the errors pre-2008. And then the last bucket, and probably the most important bucket, is we believe that there needs to be some defined, explicit backstop behind the GSE's MBS, so that investors understand exactly what the government's role will be should there be another hiccup in the marketplace. That can take different forms. Congress could get involved and create an actual explicit full faith and credit backstop. But there's other ways to go. The GSEs could theoretically go to Ginnie Mae and purchase a wrap on their securities. There's ways to take the unexpended portion of the Treasury line of credit to the GSEs and redeploy that to backstop their MBS in a more durable way. The PSPAs are dicey because it's just a contract. It's not durable, but is there a way to make that more durable, less subject to change, but give investors the confidence that there is a defined role for the government should the GSEs ever run into trouble again? And I think that's the most critical thing to make sure that GSE reform at the end of the day, or GSE release, doesn't result in higher long-term mortgage rates. So, I mean, our end state objectives is, don't disrupt the market, preserve what is the second most liquid fixed income market in the world, probably. Preserve the TBA, preserve the 30-year fixed, preserve level playing field. But the backstop is the thing that keeps long-term rates where they are. And that, I think, fortunately, has been, to the extent that the administration, Secretary Bessent in particular, has publicly spoken about where this administration would go on a GSE exit. That has been Secretary Bessent's benchmark, is we're not going to do anything. We're not going to do it in a way that raises long-term mortgage rates. As long as that's the benchmark, I think this will be a deliberative process. It will take some time. They've got 3.5 years. They may not complete the process, but they will hopefully set in motion a process that they are out of conservatorship in some sort of defined window.
One quick follow-up on that. The
Yeah.
midterm elections, could there be, I mean, like, I don't think this has to go through Congress, but you mentioned a couple elements to it that may have to be approved by Congress.
Yeah.
Do you sense any sort of, desired acceleration of the process to beat the midterms by the Trump admin? And is that even possible?
Again, I think they believe that they can, well, getting them out of conservatorship does not require Congress. So they're going to do what they're going to do, regardless of what happens in the midterms. I don't think that's a driver. Again, Congress is asked to be consulted. If there's a party switch in either body, you'll have hearings, you'll have pushback if there's a party switch. But the administration can do a lot of this. The GSEs are building capital, so at some point they're going to have sufficient capital to stand on their own 2 feet. So I don't think, I think the only thing that gets Congress engaged on this is some sort of precipitating action. They do something that does create disruption in the marketplace, and Congress feels like it needs to step in.
I see. And Pete, we've hit on most of the big picture topics, but what else, behind the scenes, important, but maybe not as publicized issues that the MBA team is working on behalf of our industry?
I mentioned some of the things we're doing on the construction side, construction lending side of things. We also have a group very active on the condo finance side. Condo financing has gotten extremely difficult. Again, it's the affordable part of the market. There are both supply issues there, but there's also access to credit issues there. We're doing some work in that space. I think the biggest one, most impactful one, is the work we're doing on single file credit report. I know some people have suggested that that's just performative on our part. It's not. There is a lot of work being done to evaluate whether or not we can move out of the tri-merge framework and towards a single file credit report, perhaps supplemented with other data. But I don't think we believe that if there's disparity in coverage between the 3 bureaus, that just requiring that everybody purchase all three is the answer. We think competition would encourage the bureaus to work harder to boost coverage. And we think there are other data sources that could perhaps be deployed to fill in any gaps that might exist in a single file credit report. And so I know, the topic I hear about most these days when I talk to our members is the cost of the credit reports and the frustration that has brought. And so this work that we're doing on single file is real. It's not going to be easy. It doesn't mean we shouldn't try. And we think at the end of the day, the only way to solve the problem of the pricing problem we have is to have a competitive market in the credit reporting space. So that's a big body of work that our Residential Board of Governors has a working group that we're working on, trying to make sure that we can do this in a way that doesn't expose certainly the GSEs, but also our members to any additional risk. We think there's ways to get there. So that's a big body of work.
So Pete, I've got to just play devil's advocate here a little bit. So, and you alluded to the condominium issue. When you talk about affordability, it's something we talk about often on here. And Rich mentioned earlier that, we have a severe shortage of housing out there. And I will point to, well, gee, we've got builders sitting on inventory. You've got for sale signs increasing in neighborhoods. That aside, when you talk about the increase in credit report cost, whether that's driven by Fair Isaac or whoever, $50, $100 or whatever it might be, don't you think that pales in comparison to when you talk about affordability, doesn't that pale in comparison to, say, having your insurance go from, $500 a month to $1,500 a month, or receiving a condo, a special assessment if you're in a condominium complex because the rebar is rusting and everybody's got to come up with, $10,000 or $20,000. Don't the other affordability issues outweigh 50 or $100 for a credit report?
Well, first of all, I think it's more than 50 or 100 because I think our members are eating a lot of the costs. I also think there's some look, I'm going to grant you, yes, this is not the single most important affordability issue. It's not just an affordability issue, frankly, for our members, it's a profitability issue because they are eating significant amounts of the cost of the credit reports today. We don't want to be in a position of having to charge borrowers just for a pre-qual to charge them for their credit reports. We're trying to avoid it ever getting to that. And I think about the friction in the system of almost every applicant, not just closed loans, but there's a lot of fallout. And every applicant getting 3 credit reports, it just is not a well-functioning market when you've got one lane to cross the bridge and there's 3 people in the toll booth, each collecting a fee. It's got to be a better way.
Good analogy. I got to think about that one a little bit. Did you come up with that just on the fly here, or have you used that before?
I have used it a couple of times before.
Okay. All right.
Good stuff. And as Robbie promised me, the attendee count soaring at the end of the show, because we moved the show up today to accommodate Pete's schedule. So if you're just logging on right now, we're actually towards the end of the show now. But as you all know, that's where most of you listen. This will go immediately to Pod and to YouTube as soon as we are done. But we did just see 100 new people join on. And Amy Bohr asking Robbie,
Pete,
if you just finished Pilates, Robbie.
If you think Bewitching Hour at the NBA annual after One Republic performs is a good way to pick up girls, no, staying outside the Pilates studio, Reno, Nevada, with a haircut that's like this.
Pete, you couldn't have.
I don't work out. I don't work out. It's not my thing.
Pete, you couldn't have pushed back that Thursday afternoon massage another hour to have accommodated the big picture airing.
Hey,
Anyway, don't answer that. Don't answer that.
Are we allowed to say the better massage parlors are in Baltimore? That's a Justin Tucker app. No, we should just leave it. Not DC. Okay. Anyways, sorry, Rich, took over your show here.
No, all good. All good. So, but yeah, so but a little recap for those of you that are just jumping on. This was phenomenal, and I would advise everybody to listen to.
Wish you could have joined.
Well, no, I mean that's why it's on podcast and YouTube, and more impetus to subscribe for those. But Pete went through just a litany of things that the MBA is working on, including a lot of things I was not 100% aware of. So, which is great. And as I say quite often on this show, we would be screwed beyond belief in this industry without the MBA. The DC machine, not always the biggest fan of our fine industry here, and we need fine people like Pete and his team. Just fighting on our behalf on a daily basis. Forget, forget the legislation we need to get passed, but preventing bad legislation, Pete, probably even more important, right, in the MBA world. So,
Spent a lot of time doing that for sure.
So are we going another 10 minutes or was this it?
Yeah, I thought Pete had to jump, so I figured you, me and Rich could talk about, retail sales or employment figures or kind of what, some economic stuff, just to keep people
All
from
right.
talking
If
off.
Pete jumps,
if Rob asks him just one more Palti question, he'll jump off right away. So yeah.
yeah,
I'll bail
flee.
quick.
So Rich,
No, I'm
Rich,
good.
when will
I'm
this
good to
be on
3:15.
YouTube?
Okay.
I'm good till 3:15. I can stay on as long as you need me to. But if you guys have other business to cover, certainly I would yield back. I hate to do this. When does your show end, Rich?
I mean, typically it's 3 to 3:45, but
East
Okay.
Coast time.
So
East-
Pete, it's 45 minutes. We wanted to make it an hour today, so people logging on at the normal time wouldn't be bamboozled completely.
Got it.
Obviously, we've driven it. Folks can't even get the podcast time right. What makes you think we can get credit reporting right?
Pete, one follow-up I had that I am fascinated, I think it would be hugely impactful, is to give IMBs the ability to originate construction to permanent loans. If memory serves me correctly, when Mel Watt was FHFA director, Fannie and Freddie were going down that and were pretty far down that path. Then there was the Mel Watt controversy at the end that kind of squashed all that. Then, but I mean, what does that kind of look like to an IMB potentially?
Yeah, I think the key issue, and Rural Housing Service does this, you can securitize the loan while it's still in the draw phase.
Okay.
So that the IMB isn't taking the interest rate risk for that full period. And that's one of the biggest, when we hear from our members, one of the biggest challenges to getting IMBs, more of them and more volume in that space from the IMBs. So we have, again, being able to not have to re-underwrite the borrower if you go 14 months instead of 12 months and everything gets stale dated and you have to rerun credit and everything else and then find out. I mean, those are issues that are challenging for independent mortgage bankers because they can't take that back on balance sheet. So these are the kinds of things that they seem maybe small, but we think, from what we hear from many of our independent mortgage banks, things that we think will make a difference. And we've got some great folks. I saw Dottie Shepik on earlier. Dottie is an industry consultant who's done a lot of work in this space, and she's been very helpful. She's been very helpful to guiding us on these issues. And look, the GSEs are going to have to put in place some risk mitigation requirements that the IMBs will have to follow, but we think there's a viable way of getting there.
We need Dottie on the show rather than four white guys.
Go with the A team, not the B team on C2P for sure. She's phenomenal, and would be a good guest for your show.
Absolutely. Because to me, it's an affordability issue too. Because just working with a lot of depository clients, they're all so limited on the stuff they can put on the books, especially fixed rate. Now, maybe you get some regulatory relief, hopefully, from this administration that makes that and some other things a little bit easier on depositories. But if indeed, the people that are saying we're 5-6 million homes short in America, and you've got a builder that's leading FHFA, you would anticipate robust construction activity in America these next few years. I'm a little worried that the depository structure, could ably handle it all. Maybe I'm off. I don't know if you have any thoughts on that, Pete.
So we have been working to also try to find ways to bring banks back to the mortgage space. And I think probably the single largest remaining barrier, and there's a number of them, certainly the hangover from 2008 and the reputational risk and those sorts of things. But look, the market is a very different market than it was pre-2008. I look at our mortgage credit availability index, and normally when you see the market be as tough as it is right now, we used to compete on underwriting. It doesn't happen anymore. The credit availability index today is only a few points higher than it was in 2012, and it's like light years away from where it was in 2008 if you look at our data. So I think that I think bringing the banks back would be a good thing. Now we think of it in two. I think the one big issue that's holding them back, particularly in the mortgage banking space, is the risk weighting on mortgage servicing assets. It's extremely punitive.
Insane.
And yeah, and so we have made our ask yet again to have each of the agencies reconsider the weighting of MSRs on bank balance sheets. That's a major one. The other significant one, so there's still critically important liquidity providers to the IMBs through the warehouse lending shops. Warehouse lending has a 100% risk weight on the warehouse line, even though every loan collateralizing that warehouse line is risk weighted at 50%. And so why, if the loans default and the bank takes them on the balance sheet, the risk weight goes down, makes no sense.
No sense.
So that's another area where we think by lowering bank risk weightings on warehouse lines to where they should be, which is, look through to the underlying collateral, because they've got possession of the collateral. They're in a really strong position. The losses in the warehouse space that usually occur because of fraud, not because of credit risk. So that's an operational risk issue, not a credit risk issue. And if we can bring the banks back, or not bring them back, but give them, if they're not going to come back in as lenders, originators, and servicers, let's at least make sure that they're robust and able to support the IMB sector through their warehouse lending programs. So that's another area.
Pete, I think back to the day when you had Chase and Wells and B of A. They had correspondent channels, they had wholesale channels, and for one reason or another, they exited those channels, whether it was the FHA False Claims Act fear, or risk weighting, or having a cap on their assets, whatever it might be, or just saying, wow, we can't regulate we can't regulate the broker channel well enough to guarantee that every loan that comes to us through that channel, through the wholesale channel, is going to be compliant. It seemed like there was a hodgepodge of reasons why Wells and, like I say, Chase and so forth got out of that channel, out of those channels. So, but if I go to Wells Fargo branch or JP Morgan, I can get a loan. It's not like they're not originating home loans, right?
It's become a product and not a strategy at many of the banks. And that's
right.
We'd like it to be a strategy again.
Yeah, that's a good differentiation.
Again, I think one of the strengths of our housing finance market is we have all these different business models and channels. We've got banks, we've got non-banks, we've got credit unions, we've got community banks, we've got wholesale, we've got retail, we've got consumer direct. All those things are very good in terms of, they'll go through cycles where one will be ascendant, but I think that makes the market stronger. As we spend a lot of time trying to make sure that, we're focusing on every segment to make sure that, people can thrive. But that's one of the strengths of our housing finance system.
That's a tagline for your marketing team. Once again, rather than have them design primordial fern palm trees, we're here to help people thrive, or we're here to help lenders thrive. Anyway,
Rob, are you looking for a job? Send me your resume. I'll send it over to the marketing team.
Open to work on his LinkedIn profile. Go check it out.
The green banner. Oh, funny. Well, good stuff, Pete. Thank you so much for, you lost power in the MBA building today, and rerouting. Rob, your hand's up again.
So getting back to my question about for the folks who missed the first, 45 minutes or an hour, Rich, when will this be on YouTube? Because I'd like to put it in my commentary, the link, because I think Pete expressed what the NBA is up to very well.
Yeah, 20 minutes after the call ends, it's up. So, yep, on Pod and YouTube. So, yep.
Okay.
Cool.
Sorry, go ahead with your ending remarks about
Yeah,
depth.
no, I was just
you.
thanking Pete for making time for us today, and more importantly, the conversation. This was great, Pete. Really, really insightful. Yeah, just appreciate you making time and educating our listeners, and all the best to you and the team doing God's work there at the NBA. So.
Thanks for the invite to come on. Happy to do it again. Rich, congratulations on Ohio MBA. That's phenomenal. Looking forward to working
Fired
with you on
up. I'm
that
so
one too.
excited to work with you guys and to just do some
Yeah.
really great stuff on the state level. So I'm so looking forward to that. And just more interaction with all my friends at MBA. So it'll be fun.
All right, Rob, shoot me your resume.
Will do.
And thank you all for spending part of your Thursday with us. As always, you can find us on podcast, YouTube. To sign up for the live, go to chrismancommentary.com and have a great rest of the week and weekend, everyone. And we will see you next Thursday at 3 Eastern.
Okay, everybody.
Take care, everyone.